Another solid day for the broader markets. Yesterday's quarterly results continue coming in, and optimism over a soft landing increases. For more on the markets and earnings, I want to bring in Kara Murphy, Chief Investment Officer at Kestra Investment Management. Good morning to you. We've been on a nice little run. I mean, more than a nice little run. And I think I don't know, some people just say you got to ride the run. The train's left the station, stay on the train. Others say this train is, way past the station.
I think the train has indeed left the station. I mean, S&P is up almost 20% so far year to date. But the question is always what's happening next.
Yep.
And I think from here, the character of the market really changes, right? For the first half of the year, it's been the Big Seven show.
Yep.
That can't last forever. We have to eventually see the market broadening out. And typically when we see a rally in a very concentrated part of the market, that's what we see.
It's been like this for the last 3 years, meaning the Big Seven, that's a new phrase for us, I think, but the FANG stock, whatever it was always such a huge concentration in the market, and it was, during the pandemic, it's what moved us down, it's what moved us up, it's what moved us down again, and now it's what seems to be moving us up again.
There have been periods for sure, right? It's not unusual to have a handful of names that are driving the market. What's unique this time is, number one, the smaller number of names and the extraordinary difference between what's happened to them and what's happened in the broader market. You have the Big Seven that almost doubled in 6 months, while the S&P is up 20%. 20% is pretty good, but that differential is really enormous. Again, mathematically speaking, you can't have that continue forever. And we've started to see it shift a little bit. I mean, if you look at the market from end of May to today, Russell 2000 is actually outperforming the NASDAQ. By a little bit. So it's not a lot, and it's not enough to say that we've definitively sort of changed here, but it does feel like sector performance is broadening out. Small caps are starting to participate.
So you think the rest of the market catches up? This is not a case where those high flyers come back to earth in any sort of way? This is going to be continued to push forward, and it's going to happen?
I think it's a little bit of both. And, it'll be particularly interesting now that we're heading into earnings season. If you look at the tech sector overall, the PE there is up 40% year to date. So, that's a lot of optimism built into not just those very narrow set of 7 names, but across the sector. So I think there could be some sort of coming back down to earth for some of those names. So it's going to be a combination of both.
So under your scenario, you would rotate out of some of those 7 names and you would rotate into...
So small caps, right? I think we start to see some pickup there.
You'd buy an index, or you'd actually go start picking
Russell
names?
2000?
Yeah, I think Russell 2000, S&P 6, I think playing it by the index is a great way to get exposure. I also think, even within the S&P, if you start to see some sectors outside of technology, so like industrials, for instance, there we've seen manufacturing has kind of been left for dead for a long time. PEs are down so far this year. We might be seeing a bottoming in some of those PMIs. So I think there you could see some good opportunities. And then, of course, outside the U.S., the valuation differential between the S&P 500 and EFA is at the highest it's been in 10 years. So you're kind of being paid to take a little bit more risk outside the U.S. as well.
What about bonds?
Bonds are actually very interesting. I called 2022 like the existential crisis for bonds. A lot of people were saying, why do I own these at all? But with that, you have extraordinary volatility that got baked into these names. That's usually a pretty interesting time to get into the market. So eventually, we're going to start to see the yield curve normalize. And with that, you can find some really good opportunities in fixed income. So the middle part of the curve, things like munis, corporates, high yield, we probably wouldn't be getting too far into because we do think that there's some sort of credit risk out there. But that belly of the curve should really benefit as the yield curve starts to normalize.